Stay tuned for Retire Your Way with Dale Soutas, a leading financial retirement strategist and the founder of Soutas Financial and Insurance Solutions, right here in Fresno. Every week, Dale discusses pressing financial topics of the week, ranging from reliable income strategies to our financial markets, including Social Security, tax strategies, wealth management, RMDs, legacy planning, long-term care solutions, and most importantly, how to make sure you have enough guaranteed lifetime income to retire your way with choice and dignity. From taxes to trends to total transparency, Dale covers it all. And now, here is Retire Your Way and Dale Soutas. That's right, friends. This is Retire Your Way with Dale Soutas, financial advisor and the founder of Soutas Financial. Every single week, we like to come to you with retirement planning strategies, solutions, and things you should be looking out for. We actually have a full booth today, because not only is our financial advisor, Dale Soutas, in here, but we also have another great friend who works in the office, our Medicare Medi-Cal specialist, Katia Flores. Katia, how are you doing? I'll start with you this week.
Hello. I am doing well this week.
Welcome back to the California airwaves. We're now in more stations. You are probably broadcasting over half of California right now. How do you feel about that? Is that making you nervous?
Oh, my.
It's thrilling. This is thrilling.
Well, we brought you on purpose. Dale, actually, he threw me over a topic, and I said, Dale, buddy, no idea what you're talking about. Dale, what was the topic you want to talk about today that you said we've got some big changes coming to this year?
Yeah, coming up next year, the Medi-Cal program here in California is changing back to some of the rules they had prior. Basically, big changes. So asset changes. They're going to be looking at assets again instead of just income like they've been for a couple of years now. So these changes are coming up January 1st of 2026. People need to be aware of that.
Wow. And why do you think? You think this comes from taxation? Was it temporary to begin with, or people realizing, hey, over the last couple of years, they tried to do it one way and there isn't enough money there? What's going on, Dale?
Yeah.
Or Katia, yeah.
Yeah, I think I can step in here. You know, as a state, I think we had the good intention to do away with the asset limit, really open up the door for seniors that needed this program. Due to, as I looked into it, federal funding not coming through, as well as, pots that the state was hoping would bring in some revenue were not coming through. And so it was in May that Governor Newsom put in his budget revision, and a little bit of back and forth between state legislature and governor, and lo and behold, end of June, they signed in the new asset limits that will be going into effect at the beginning of the new year.
All right. I guess we'll discuss what some of those numbers are. My first read on this doesn't sound good. Doesn't sound like it's an improvement. Sounds like something that's kind of being rolled backwards.
Well, it's something we've dealt with for many, many years. I learned about what we call the long-term care Medi-Cal programs way back in 1997, and we had to deal with the $2,000 asset limit for individual, and a little over 100,000 plus for a married couple. So we've dealt with it forever, so to speak. Mm-hmm. And so it did go away for a while, and I think the states realized, a lot more, more people have been getting on the program, and so to tighten their belt, they're putting the limit back on. But probably we should make sure you and others understand what's the difference between Medicare and Medi-Cal.
Thank you very much. That's exactly what I wanted to ask you that, both of you, for those of us back here in the cheap seats who don't really understand, there's Medicare, you're talking about Medi-Cal. Are they similar, totally different? Who can clarify this for me?
Those are going to be two totally different benefits. Your Medicare is going to be your age-driven. That's our insurance-based benefit. We've all been funding into the pot, and when we are of the right age, we are eligible to receive this benefit. The long-term care Medi-Cal, different program, different funding, different rules. This program is need-driven. When there is a need for long-term care, then the door can be open to use this type of Medi-Cal benefit. Rest of the country is going to call it a Medicaid benefit. Here in California, we refer to it as our Medi-Cal. Because we like to make things tricky here.
No, but okay, I get that helps a little bit. The Medicaid, yes, when you've totally spent down on assets, then you're looking at that for your coverage for health, long-term care. We're going to get into those things later. So Medi-Cal is specifically for those who have underfunded or just don't have their own funds for health and long-term care here in the state of California. Am I closer on that?
I like to say that there's two different types of Medi-Cal. On the one hand, we've got those general welfare Medi-Cal benefits that we're most familiar with. But the type of Medi-Cal that we focus on and the type of Medi-Cal that we're seeing the changes coming to is specifically for long-term care. We also call this ABD Medi-Cal, or age blind disabled, over 65, if you've got a disability, if you're in long-term care. This is the type of Medi-Cal you're using, much different from the general welfare Medi-Cal benefits that we're familiar with.
Okay.
Yeah, and so when you think of Social Security, that's usually age-driven, right? Unless you're disabled, you can get it early. Likewise, Medicare is health insurance, usually driven at age 65. You can get it early if you're disabled. But when Medicare came about, it was Lyndon Johnson that signed the Medicaid bill. And inside Medicaid is a little understood long-term care program that's based on, like Katia said, need, not age. So we don't want to get to an age like as old as you are, Spike, and have to be put into a nursing home, right? You're welcome.
Thank you very much.
So, but it's if you need that assistance, there are programs to help pay, like Katia said, to keep you taken care of at home or some kind of cruise ship on land, we call assisted living, or even in a nursing home. So there's some benefits there we can access, and everybody thinks, you have to be totally poor to get it, but that's not necessarily true.
Well, that's why I want to take a little bit of a deeper dive, and that's why you're listening to financial advisor Dale Soutas and our Medicare specialist today, Katia Flores, all who work here at Soutas Financial in California. So very first off, for people like myself learning these phrases, Medicare, this is not affecting your Medicare. We're talking about Medi-Cal. We're talking about some things that can help you possibly with long-term care coverage, nursing coverage at your own home. And we'd had some different things, some parameters that were set in place. Seems like some of them are rolling back or changing. So let me go right to Katia here. What types of Medi-Cal, or what exactly is being affected by the changes that will be taking place next year for 2026?
Yeah. So the changes that we're seeing are not necessarily regarding the general Medi-Cal benefit, but specifically that ABD, that age blind disabled. So if we are 65 or older, if we are one with a disability, or we've have a loved one that is in a nursing home getting long-term care, we will be seeing the asset test being reinstated effective in the new year. To touch a little bit on that asset test, it's funny. It was back in '89 when this program came about, and with it we had the $2,000 asset limit, and for decades it remained the same. Up and down California, can't have more than $2,000 in assets to your name in order to be eligible for this type of benefit. Married couple with someone in the nursing home could have a little bit more, but we were really confined to what we could have. And it wasn't until 2022 when we made the first big change to this asset limit. And it took a jump from $2,000 all the way up to $130,000 for a single individual. Huge jump.
Yeah.
Now, if you had another household member also seeking the Medi-Cal benefit, you can have an additional $65,000 on top of that. If you're a married couple seeking the benefit for long-term care in a nursing home, the limit was set at a little over $270,000. Now, in my opinion, these were good changes to put into place. It meant that more Californians that had some savings were not necessarily being punished and now unable to use these benefits. We were really opening the door. But then in 2024, California really opened up the door, and we did away with the asset test. So they were no longer looking at what you had in the bank. Do we have additional properties, stock, bonds, mutual funds? They were not looking at your assets to determine eligibility. Now, your income dictated how much you spent out of pocket, but your assets were no longer being looked at. And as I said earlier, it was just in May of this last year when the governor did his budget revision, lo and behold, resetting us back to the 2022 limits. So effective January 1st, 2026, we are going back to the asset limit of $130,000 for a single individual, $65,000. If we have another individual in the household seeking Medi-Cal, an additional $65,000.
So 195. 195 we're looking at. Okay.
And a little over $287,000 if we are in a nursing home, married couple in a nursing home needing this type of benefit. So it varies depending on where we are.
Now, these are just numbers. The life becomes so complicated here. So first of all, how do you get the care? Who is caring for you? The reason I think these numbers are so important is that between couples, our goal with Dale Soutas as a financial advisor, you, Katia, as a Medicare specialist, so we're telling people to save as much as they possibly can throughout their lifetime so they can make sure that they take care of these needs later. But then if we really do need help from some of the state programs, it's the opposite. It's like you've got to get rid of your assets. And it's not like you can do it that year when you need the care and just give it away to your kids, because there is a look back on this. Well, hey, good. I'm glad that there's a maybe on that. Katia,
there's maybes.
Put a pin in this. Hey, good. I'm glad that I'm wrong because I was bumming myself out, but we have to take a very short break right now. We're going to continue to discuss about this. What are the Medi-Cal ins and outs, not just for this year, but the changes for next year? What are the possibilities? It does sound like Dale Soutas, your financial advisor, and his Medicare specialist here, Katia, have some solutions for you, so don't go anywhere. Call the phone number right now if this is one of your biggest concerns about running down your assets in retirement. 833-856-1382. That's 833-856-1382. More Retire Your Way with Dale Soutas and Katia Flores, the Medicare specialist, when we get back right after this.
How do you know if you're retirement ready? That's a question many people ask themselves as they approach their golden years. We believe the answer can be complex and depends on many factors, such as your savings, monthly expenses, and lifestyle goals. At Soutas Financial, we can help you determine if you're retirement ready. We'll work with you to assess your financial situation, identify any potential income gaps, and develop a customized plan that aligns with your goals. Don't leave your retirement to chance. Call us today to learn how we can help you work towards achieving financial security and peace of mind in retirement. Call Dale Soutas and the team at Soutas Financial for your complimentary retirement readiness review. Call 833-856-1382. That's 833-856-1382.
As a valued radio listener of Retire Your Way, Dale Soutas and the entire team of retirement professionals at Soutas Financial invite you to schedule your very own complimentary retirement planning session. If you don't have a retirement strategy mapped out that includes low-fee investment elections, tax minimization strategies, decumulation plans from your savings that will last as long as you need them to, are you able to lower your taxes in retirement? Are you unclear about your Social Security, Medicare, investment fees, and risks, or how to produce ongoing income that lasts your entire retirement? Then call Dale Soutas of Soutas Financial to schedule your own comprehensive retirement planning session. No cost to our valued radio listeners. 833-856-1382. That's 833-856-1382. Welcome back to Retire Your Way with Dale Soutas of Soutas Financial, a financial advisor and the founder of the firm. We also have in the booth today Katia Flores, who works in the office, Medicare specialist. I could also say probably long-term care planning specialist. It's something that Dale has actually had a huge background in, but as the firm has grown, all hands on deck. We need as many people helping as possible. So great to have you here, Katia. You both were laughing at me before the break. I always appreciate that. But,
you're welcome.
It sounded like you've really got to spend things down to be able to get the assistance. And it's not like you can just give it away to the kids. And then you both said, wait a second, there are some options.
Yeah, before I pass it to Katia to give some of the nuts and bolts, but since 1997, we've been helping thousands of families protect their assets, qualify for the program so they don't go totally broke, especially if they're married. I mean, if you have to spend down, everybody thinks you have to spend down to $2,000, and if that happened, what's the well spouse have to live on after that, you know? So we've helped thousands of families protect their estates, get on the long-term care Medi-Cal program, and protecting those assets. There's many different ways to do that. So even though we're going back to that asset test, there are ways to protect it. And there's a lot of people that may have a loved one, or they themselves are on this age-blind disabled Medi-Cal program that is going to be, you know, in the new year, starting to look back at what you have in the bank, how many what property values.
All right. Well, since we have Katia here, I'm going to ask her then specifically, since you deal with the Medi-Cal, tell us a little bit more, especially for our radio listeners out there. What are the exempt or the countable assets when it comes to Medi-Cal?
I love this question, often because I find that most of us are worried about some of our assets that fall under the exempt column. Now, exempt meaning the value of this asset does not count against you. That's going to be your primary home, so you are able to own your home and utilize this benefit. Your primary vehicle, one vehicle, household goods, personal property. The other big one is going to be your retirement accounts, any of your IRAs, 401ks, 403bs. They do not look, it's quite interesting.
Oh, that's huge then.
Yeah, they don't necessarily look at the money in the pot. Now, I will say they do look at your RMD, that required distribution that you've got to take. They are going to look at that as your income, but they won't look at the money in the pot as an asset that counts against us.
Okay, this is huge because, I mean, this is where a lot of folks, millions of Americans, have their largest amounts of savings.
Correct.
So this is also the house, because, when you look at somebody's net worth, if the house is paid off, if the car is paid off, and I don't know, collections, the wine collection, is the wine collection exempt? I don't know.
It is exempt. Your personal property will be exempt.
Okay, but then
prepaid burial, yeah. There's a number of things. One thing on the primary residence, what if you own two properties and they're adjacent to each other? So
like one is a rental property, or?
Well, let's say you have your home and you own the home or property, that's adjacent to your property. That is also exempt with your home. So that's something else that factors in occasionally for people.
Okay. Now, that's great, because you could have several $100,000 in your IRA, your rollover. This is, I think, a huge reason why it's so important to speak with a financial advisor about trying to set yourself up for retirement. Because let's say that 401k, because I think we're going to get to the things that are countable. Let's say you got to 65. Let's say you retired. Let's say you rolled out your 401k. You put it into annuity because you want to create income for life. Now that you've taken it out of a 401k, rollover out from an IRA, does this now become countable, or since it was 401k money, is this off the table as far as what is countable?
Well, no. Let's say a person, while they're working, had a 401k, 403b, TSP, whatever. And maybe, if it's still in that manner when they retire and now need help, it's exempt. But what if they've all rolled them over to an IRA? Well, then obviously IRAs are also exempt. It's just the money they take out will count as income, which will calculate in a different manner for what they might have to pay for their care.
Yeah, we like to use that technical term of qualified versus non-qualified.
Yeah, that's just one of those gray words that I think is confusing to people. Taxed, non-taxed. How about, well, you've got 401k. Does that include the Roth 401k?
Well, that's why it's so helpful to be able to contact Soutas Financial and let us help work you through it.
Yeah.
Yeah, knowing the eligibility on Medi-Cal, that's what I've helped. That's what actually Katia's been helping families now for about 10 years. So it's been a wonderful thing to be able to keep helping families in that situation. It's not a giant moneymaker for us. It's just a wonderful service. And the Roth version of a IRA, 401k, those likewise can be they're considered exempt as well. Yes.
Okay, so let's flip the script on this. What are the things that are countable for sure against your Medi-Cal?
That is going to be money in the bank. What do we have within checking, savings, CDs, money markets, stock, bond, mutual funds that are not wrapped up in your retirement account, any annuities that are not retirement funds. If you've got cash value on life insurance policy, so not necessarily a term policy, those don't have the cash value, but a whole life policy, cash value will count. And then if we've got additional properties or vehicles, those are going to count as well. And that's where we will see the 130,000 asset limit coming into play. Those countable assets cannot be over 130,000.
Right. For the individual. Now, let's say dad's in the nursing home, mom's well at home. She can still have that additional 147,000 on top of his 130,000.
Yeah.
So, but if they're $1 million, they got 500,000 too much or $1 million over the limit, our job is to show them, well, how do you either spend down on yourself? How do you, let's say they still have a mortgage. They could put money towards a mortgage and come under the limit. They can prepay their burial. They can upgrade their vehicles. I mean, there's all sorts of things. And they can accelerate their will by putting money or gifting money to their children, basically ahead of time. So there's a number of different things that can be done to, get under the limit as well.
All right. You were just saying individuals there, the married couples, you said one of them in the, oh my gosh, I'm getting so confused already, folks.
Yeah.
It's hard. So how about this? What if you are currently on Medi-Cal benefits? Does this impact you? Are you going to get kicked out of them next year?
No. Well, not necessarily. What we do know is that for those currently on the Medi-Cal benefit, the state is not going to look at your assets until your annual renewal. So you've got until then to ensure you are under that limit of the 130,000. Now, one of the pieces that I think is very important, and truthfully, Dale and I had been waiting to get this key piece of information from the state regarding how asset transfers would be looked at for the remainder of this year. Meaning, let's say that I am an individual in a nursing home, I'm on the Medi-Cal benefit, and I've got 200,000 in my name. I am able to, in this year, transfer that out and not have it create the penalty of ineligibility. That is where the state is giving ones the opportunity to essentially get your ducks in a row before the end of this year to ensure your benefits continue on.
Okay.
And that's where I think it's so important. I tell my families this information, it's not just helpful to you. It's helpful to your neighbor, your friends, your family, ones in your community. We should all be talking about these changes so that none of our loved ones are in jeopardy of having their benefits discontinued if they are so vulnerable and in need of this care.
All right. Yeah, we definitely don't want anything discontinued. I think that's always the worry and the confusion and why people do pay attention so much to the news that's going on. But just take this as a cautionary and educational segment of our program today. But do take a little bit of action. The way that we've done this just for so many years in the office, we might be able to know our ways in and out of how to help make sure that you can stay covered. Maybe your county is different. That's something we've discussed before, that even how different counties kind of make sure that you are covered. There's just so many different fine details, and we don't want you to have to do all your research on your own. And maybe you're doing it for yourself. It's getting confusing. Maybe you're doing it for mom and dad. But we want you to know that you've got a resource right here. You can call our phone number. We'll do your Medicare and Medi-Cal review. 'Tis that season. We're going to start seeing all those Medicare commercials, but these are two very separate subjects from one another. The reason I even say the word Medicare is we want you to know that Medicare is not going to cover your long-term care costs in retirement. So we're either going to need to do one of a few things: self-fund, use tools that might be able to have a multiplier to help us with it, or we might need help from the California programs. You don't need to be absolutely without assets to be able to get help. If that sounds like a relief to you and you want to make sure that you're covered or your parents, give us a call. We'll have that conversation with you. 833-856-1382 is the phone number. That's 833-856-1382. This is Retire Your Way with financial advisor Dale Soutas.
Are you worried that you waited too late to start your retirement planning? That you waited too late to start saving? At Soutas Financial, we believe it's never too late to start planning for your future. We can help you develop a personalized retirement plan that is tailored to your current needs and goals. The team at Soutas Financial will sit down with you and provide an evaluation of your current path, including your investment strategy, tax planning, and risk management approach. We'll help you identify potential areas for improvement and work with you to create a retirement plan that is designed to help you work towards having financial security and peace of mind in retirement. It's not too late for you to get started with Soutas Financial. Call us today to schedule your complimentary retirement planning session. We believe we can help you get on the path to financial security and peace of mind in retirement. Call Dale Soutas and the team at Soutas Financial to get started on your own complimentary written financial plan. Call 833-856-1382. That's 833-856-1382.
Call Dale Soutas and Soutas Financial and Insurance Solutions right now to receive your complimentary tax map with your retirement readiness review. Learn multiple strategies that could protect you from higher taxes now and in the future. Taxes are a threat to your financial stability in retirement, so help protect yourself from the potential threat of rising taxes. Call Dale Soutas and the team at Soutas Financial to receive your complimentary tax map and retirement readiness review. 833-856-1382. Their team will help you navigate the financial waters to pursue your retirement goals. They offer inclusive retirement services such as investment directives for your portfolio, income-producing strategies, and wealth preservation plans for your family and legacy. Call Dale Soutas and the team of Soutas Financial and Insurance Solutions, 833-856-1382 right now for your retirement readiness review, and also receive your complimentary tax map. Strategies to help you keep more of what you've saved in retirement. Or write us at the email address dale@soutas.com.
Call the team at Soutas Financial so we can help you design a complimentary written income plan to help you live the retirement you've always wanted. Call 833-856-1382.
This is Retire Your Way with Dale Soutas of Soutas Financial. Once again, the phone number for your absolutely no-cost portfolio, your investment risk cost review, and your income plan is absolutely no cost to you. 833-856-1382 is the phone number. Call it. We have folks who are standing by. You're not going to interrupt the program. We're not going to air your dirty laundry. We do this in private, but we can do it over phone, over Zoom, or in person in the offices if you want to, right here in California. Dale, recently you had what we like to call is a few of the youngsters come in. A couple of youngsters.
Yeah.
A couple of different groups in their 50s, and we love this. We really, really do encourage this. Retirement planning isn't just waiting for the month or 6 months or a year beforehand going, hey, how am I doing? Hey, we like to help you out along the way. There's a lot of different things we can do because it's hard to go back 15 years and change what your elections were and your investments were and your saving amounts.
Strategies.
Yes,
yeah, exactly.
And as I've been in the industry with you folks now for a long time, just hosting this always has been one of my biggest concerns because I've also seen it in my own family. Individual business owners. You know, you probably start getting that itch around your 50s. You were a worker in your 20s. You were turning into a career person in your 30s. You were turning maybe into an executive or C-level person in your 40s. And then your 50s, you're thinking to yourself, I can do this on my own better. So you open your own business, right?
Could be 40s or 50s, exactly. And they do. I've had, like you said, I've even had ones younger than, in the 50s, like I'm thinking of a couple of them recently, but that are in their mid-50s. I've had ones in their early 40s, asking for some coaching, and that's fine too. But the one I'm thinking of who is self-employed and set up S-Corp like I have for my business, we have the same mentality. A lot of times you get self-employed and you're making this money, but you're doing all you can to show as little as you can to Uncle Sam because you everything's business related and you're writing it all off, let's say. The danger there is now, how are you going to save for down the road? Because he's realizing, the one I was talking to is, hey, I can save maybe even up to $100,000 a year for my future. And I'm saying, well, that's great. It's not so much necessarily how much you could save, it's how you save it. What tools.
And I'll stop you there, because just saying, hey, I don't care if you can sock away 50,000, 100,000. Look, and hopefully he's a savvy person, but just even putting that in savings accounts or money markets at a 3% or a 4%, that's very, very different than you putting your incremental amount into investments, funds over time that are also getting growth. So I agree with you there, Dale. Sorry, didn't mean to interrupt. But yeah, you could sock away a lot of money. Saving, having that on the sidelines isn't the same thing as growing.
Yeah, and let's say he's just putting it into a brokerage account and he's managing it, or having somebody manage it, and that thing's, really rocking and rolling and making money. But if it's structured as a traditional just investment, then he's paying taxes on that growth along the way. So, he's not maximizing the growth necessarily. So, the other thing I look at is they're young. Tax rates will likely be a lot higher, 10, 20 years from now than what they are today. So I don't really encourage them to use their traditional, SEP IRAs. I would rather them use a SEP Roth IRA, if that's the proper way, but Roth, using tax-free vehicles. So put after-tax money in, let it grow. As it grows, you don't pay any taxes on the growth. And later on, you could take all of that money tax-free, even the growth. You don't pay taxes on it. So options. I did some homework for that particular family with, his business and in mind, and ended up, some of the things he could do is a Roth SEP IRA, which means he could put up to 25% of his income, up to $70,000 a year into that. Let's say he wants to put more, then he might need to set up a 401k, which also means he may have to, be contributing, helping his employees contribute. He can also do a Roth defined benefit plan, which is more like a private pension plan, but there's a variety of things where he could put higher than the 70, higher than the 8,000 a year that you could traditionally put in if you're 50 and above into an IRA, Roth IRA. But the problem with it, as I was realizing, as I was doing my homework, I said, okay, he's not showing Uncle Sam much income. And if you're showing very little income, 25% of nothing is, 25%, that's a lot of nothing.
Because you need to put earned income into retirement kinds of savings. So if he's setting up his own retirement savings account, a SEP IRA, SEP Roth IRA, whatever it might be, he has to have earned income. But most business owners try to show as much loss as possible, so they get the deductions, correct?
Right. And then...
or a lot do.
Yeah.
I'll say a lot do.
Yeah. I mean, the goal, who wants to pay extra taxes if you don't have to? But, a lot of times that's a perk to one's having their own business. And I know even as an S Corp, there have been times my CPA had me at very, it was like I'm on the payroll, which is nice because then I'm contributing into Social Security. And 1 year he had me kind of low, and I thought, well, wait a minute, that's not going to help me down the road. So, I want to show a little higher to build up my Social Security as well. And this particular case with this one's business, he needs to be able to be on the payroll, which is he's going to be starting to really function as an S Corp next year. So that's what we're gearing up for. How do you do that? How do you contribute? Not only have income so you can, put some in towards Social Security, but also what are other options? And if you show no income, you have nothing you could put into a Roth SEP, a Roth 401k, or defined benefit plan. So you're kind of making it difficult. But even if you do again, there are other tools too to do tax-free retirement income. And people don't realize they can also use properly structured life insurance. And they can
Explain.
fund
What
those.
do you mean? Okay, what do you mean by properly structured life insurance to save for your retirement as a business owner? What
A
do you
business owner, or even, if you're wealthy, making millions a year, what do they use? They use these life insurance policies. They're not trying to get a big death benefit. They're trying to get the least amount of cost or death benefit, but maximize what they put into it. People hear of things like IULs. Those are indexed universal life policies. So instead of a fixed rate of 4, 5, 6%, you can actually, make sometimes double digits or better. Double digits would be good with these.
Would you say double digits or better? Like what?
Yeah,
Triple digits? That would be wonderful.
Well,
You mean good? You mean
better
decent double
than-
digits?
Yeah, decent returns with a lot of these, but the properly structured part is where you're max funding. You're not just paying a minimum premium to get this big death benefit. If you need a big death benefit.
Okay, and I'm going to ask you for me right here. So when you say max funding and not just waiting for can you talk to me in some dollars and cents? What do you mean? Can you give me, what do you mean by not the largest death benefit, but then max funding? Is that overfunding? What are we talking about in, I guess, monthly or annual payments? Can you give us a ballpark?
Good question. In a nutshell, on life insurance, you have term and you have whole life and you have universal life. Term is like renting. Whole life is like buying. Universal life takes the best of both worlds. You're buying a home versus renting the same home, same neighborhood. Your cost to buy that monthly payment is going to be naturally higher, but eventually you stop paying for it and it has equity. It grows in value. When you rent that same home, the rent goes up over the years. With the universal life policies, when you put more than the minimum just to have that death benefit, that money can grow inside the pot, so to speak, and eventually that money is going to get higher and higher. Let's say you have, in this example, $500,000 death benefit, and you're max funding it, whatever it is, $10,000 a year. Down the road, that money in the pot may get up to $400,000 in value, $450,000 in value. Now you're only paying for $50,000 or $100,000 of life insurance. So the cost is shrinking and the money can grow even more. And with properly structured life insurance, you can borrow from these to create tax-free income or tax-free withdrawals. And let's say down the road you take $10,000 out and spend it out of that life policy. The ones with fully participating loans, you take that money out, you spend it, but it's as if the money's still in the pot. And if it earns 6% and they're charging you 4%, loan, you still made 2% on the money you took out and spent. In other words, they're charging you 4% on that $10,000, but it made 6.
Okay, Dale, before everybody's eyes keep crossing while they're out there on the roads right now trying to figure out all this math, we'll figure out the math for you. Come on into the office. What Dale is talking about here are some higher level strategies. It's great if you're a business owner. You're focusing on building that up. You're acquiring accounts. You're servicing your people, your clients. You're taking care of your family, even saving for yourself. But then creating strategies for yourself in retirement is a whole different ball game. So if you are a business owner out there wondering if you're saving enough for yourself, or a private contractor, things like real estate agents, we want to make sure that everybody has a retirement plan. And we know that cash flow is king, especially as an independent contractor and business owner. So let's make sure you got a plan that you are comfortable with, no matter what the markets and the economy do. Call 833-856-1382 so you can sit down with Dale Soutas, financial advisor right here in California, at no cost to you. More with Dale Soutas right after this.
Are you worried about taxes eating into your retirement savings? By engaging in savvy tax planning, you might be able to create greater tax efficiency in your retirement plan. At Soutas Financial, our team of retirement planning specialists can help you explore tax-deferred and tax-free investment options, as well as strategies to help potentially minimize your tax burden in retirement. Don't let taxes derail your retirement plans. Let us help you create a tax-efficient financial plan and work towards maximizing your savings and minimizing your taxes. Call Dale Soutas of Retire Your Way and the team at Soutas Financial today to learn more about our tax planning solutions. Call 833-856-1382. That's 833-856-1382.
Will I run out of money in retirement? That's a hard question to answer if you've never been retired. How do you grow your investments without taking too much risk, but also considering what you'll pay in taxes? Should you convert your tax-deferred accounts into Roth accounts for tax-free growth later? Don't forget about inflation. Instead of questions about your retirement, turn to answers and solutions. From Dale Soutas and Soutas Financial. Call and ask for your own complimentary retirement solution review. 833-856-1382. That's 833-856-1382 for your complimentary retirement solution review. This is Retire Your Way with Dale Soutas. He's the founder of Soutas Financial, independent financial advisor, fiduciary financial advisor, helping you be and stay retired, California. This is a very common situation. You get to your 50s, you start to open up your own business. Maybe he's had it for a long time. I didn't know him. But how are we saving for retirement is the key here. And if you're just piling into, your investment accounts, your own private brokerages, you've got tax consequences to all of that. And what you tried to shine a light on for him was what exactly, Dale, about his savings?
Well, he has to, if he's going to be saving, because he's realizing, he's been doing great and making money, but if he's going to save for the future, do it properly. I mean, keep Uncle Sam out of that money as best as possible. But to do so, you might have to show Uncle Sam you're making money, because you can't necessarily put money into those Roth type vehicles.
Unless you have some, you've got for any sort of your retirement savings, whether you're going to pay the taxes on it on the way in, a Roth, or if you're going to try to create your own individual 401k tax deferred, you got to show earned income. And I know, the bottom line of trying to show that your business, had expenses and so forth. But if you don't have any earned income in it, you don't have earned income that you can save.
But sometimes, let's say businesses are owned by multiple people. So then we can do the life insurance vehicles for the business, which helps, expenses for the business too. But it's more of a protect the other. Like if you have two people, you and I are the business partners, and you die. Am I going to be wanting to work with your spouse? Maybe, maybe not. So by having life insurance on you, that comes to the business for me to buy your spouse out. And then we run the business.
Okay. Now,
there's some fancy stuff that way, but the point being with this one was
I actually was thinking that when you were saying getting life insurance on each other's, business partners like that you were going to use it maybe as a salary or an incentive to go and find somebody else who has the kind of experience, because this happens a lot. This happened with a friend of mine recently. He had 3 different business partners, and something happened to the spouse of one of them, and unfortunately passed away about 6 months later. And, it was the spouse wasn't so much of an engineer in what their industry was, and the other 2 partners, they were kind of floating dead in the water for a little while, no pun intended, because they didn't know what to do with the business. The other guy was a lot more technical. So is it financial services? Is it something where you're building? Is it, a specialty, something that you only know about? Is the spouse going to just step in and take over that career? But having life insurance on key persons to be able to pay someone like that and say, thank you so much for your spouse. I'm sure you don't want to run our business. Or maybe they do.
It just helps to continue the business in a proper manner. But, it was interesting because not everybody has their own business. Most people are employed, right?
Yes, you said you had a couple of young kids recently. You had another 50-year-old come in recently.
Well, it was actually the same day, a little later in the day, that somebody came in and she was talking about, her plan for the future and concerned that, am I doing it right? And I gathered the info. Of course, like always, people might come in with a stack of statements and stuff about their income and Social Security, pensions, whatever it's projected to be. And I actually have them push that aside and say, well, first of all, what do you want retirement to look like? What are you going to be doing? That's more important, because it's like we've said before, if you're going to have a house built for your dream house, or you're going to do a modification to your own house, to upgrade a room or a section of your house, you call in somebody, a contractor, and you tell them what you want it to look like. That's what I do with people. I like to find out, so what does retirement what's it going to be like for you? What do you really want to be doing or doing more of in retirement? And once I know that, and we start building on, okay, what's it going to cost to do all that? And then we start looking at, well, what lumber do you have? What are the accounts? What's the future income to be able to do all that? But anyway, with her, it was great. And I basically said some of the homework is check with your employer. Do they offer, because she was using a traditional 401k, throwing in money, lowering her income today. Do they offer a Roth 401k? And the income she's at wasn't such that she really needed to defer the income or lower her income taxes today because, tax rates will be higher. She's saving tax at a low tax rate today to pay taxes on the money and the growth of that money at a higher rate down the road. So, just a little bit of homework like that to help her know how to save better. And for both of them, free of charge, we shared the Power of Zero movie. We said, this is a must. This is homework you need to see. It's free financial education. And I really recommend younger ones seeing that movie. If you have kids, grandkids, it's a must for them to know how to save for their future and keep Uncle Sam and Uncle Newsom out of their retirement savings, right? As I like to call it. So there's some it's very informative. I think it's only 75 minutes. So it's not even an hour and a half.
And
movie.
you have a clip on it on the website, correct?
Yeah, there's trailer for that on the website. Just look at the movies. It's Power of Zero. For older ones, for how to structure things so their money will last, their income will last, the Baby Boomer movie is excellent too. And that 2-minute trailer is on the website as well. But we try to help people get up to speed, understand sometimes the lingo, and just be educated financially, because that's not something most of us were taught in school or anything like that.
Yeah, and sure, you can let the internet do the walking for you. You can go out and do the research, and I try to do this all the time. I've been, I had a really frustrating couple of days trying to learn different AIs and trying to work with them and getting 2 and 3 and 4 hours in and still getting terrible results and realizing that I'm the problem. But you don't have to learn all of these things on your own. You've got
I could have told you that.
You've got your work day, you've got your family, you deserve to relax. You can have somebody lead you through the financial education. These 2 movies that Dale is talking about, we can get you the access to them. Go take a look at a couple of the clips that are on his website at Soutas.com, Soutas.com. And if you'd like to see one of those movies, we can give you the access. Write Dale at Soutas.com. That's Dale with the @ symbol. Soutas.com, Soutas.com, especially the Power of Zero. And I think the zero that you're talking about is we're trying to get to what? Zero in tax brackets? Zero taxability?
Zero taxes on retirement savings.
All right. But and I'm so glad. And this message we really want all for the state of California. If you're in your 50s, you are welcome to call the phone number. We like to help people, especially early on in the planning process, because as Dale teams grow here, they're going to be the ones who continue to work with you over the next 20 and 30 and 40 years. But how are you saving to get yourself to retirement? That's incredibly important. If you're in your 60s, it's very, very important to call the phone number and set up your appointment. We've got 5, 6, maybe 7 years, depending on your working years, on what you want to do, of being able to save and position things. And then if you're in your mid-60s, early 70s, if you've already retired, if you want to make sure that you've got income that is going to work for you, you should also call the phone number. 833-856-1382 is that number. That's 833-856-1382. I love that you're talking to somebody in their 50s saying, take a look at Roth 401ks. While you were discussing that, I looked because I wasn't sure. So I know that there's legislation that has allowed for 401k providers and also to be offering Roth 401ks.
Correct.
But it's not a legal requirement that if you are a 401k provider company that you have to have a Roth 401k option. I thought there was something about legislation that's saying, look, if you're going to offer one, pretty soon you have to offer the other. So your company might not. But for those of you who are in your 50s, it is a great thing to take advantage of. How about, Dale, if you're in your 60s? if you're just hearing this right now? Because Roths didn't really come out until about 1997.
Yeah, what if they're in their early 60s and they plan to work through age 70? Well, maybe we still implement some Roth strategies. Or sometimes I see people, they have, the companies do offer a Roth, but they only match what you put into your traditional. So you have the right, get that free money into your traditional, and you have the right with most of those accounts to convert that traditional to Roth. Maybe do it the next year, so you'll pay tax on it, but you now have that money growing tax-free. Or what if you're a high wage earner and it doesn't make sense right now to put after-tax money into those accounts? You do need to defer, because once you retire, your income and needs will be a lot lower. So there's, again, too many variables to look at to say everybody should be doing it this way or that way.
Oh, okay.
It's just and you could even be in your 40s or whatever. It doesn't matter 20s, I don't care. How do you save better for your future? That's the bottom line.
That's the bottom line right there from your financial advisor, Dale Soutas. Folks, call the phone number. We've got all different kinds of tools, all different kinds of education. If you go to the website, you can see when live events are coming up next, so you can go and see Dale. You can ask your questions in person. You can come into the office, or you can just have a phone call. And it all starts with this set of numbers, 833-856-1382. Call that right now. Set up your appointment, or you can go and learn more about Dale and schedule your own appointment right there at Soutas.com, Soutas.com. For Dale Soutas, I'm Spike. Both he and I will be back again next week. As a valued radio listener of Retire Your Way, Dale and his entire team of retirement professionals invite you to schedule your very own complimentary retirement plan review session. 833-856-1382 is the number for you to call. If you don't have a retirement strategy mapped out that includes low-fee investment elections, tax minimization strategies, decumulation plans that will last as long as you need them to, then call for your very own retirement review session, complimentary for our valued radio listeners. Are you able to lower your taxes in retirement? Are you unclear about your Social Security, Medicare, investment fees and risk, or how to produce guaranteed lifetime income so your lifestyle and goals don't have to be changed with the ups and downs of the market or taxes? Call Dale Soutas with Soutas Financial and be confident you can retire your way. Schedule your own comprehensive and complimentary retirement review session. Don't just live in retirement, thrive. Call 833-856-1382. That's 833-856-1382.
Katia Flores is not an investment advisor representative of foundations and does not provide investment advisory services. Dale Soutas of Soutas Financial is an investment advisor representative with foundations and can provide advisory services.
Investment advisory services are offered through Foundations Investment Advisors, LLC, Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal is converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstances. Comments regarding a particular client's experience may or may not be the same as another client's experience and is not an indication that any client or prospective client will experience the same or a higher level of future success or performance. Foundations only transacts business in those jurisdictions where it's properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio, or securities or investment strategy is suitable for any specific person. No legal or tax advice is provided. Please review your retirement, tax, and estate legacy planning strategies with a legal tax professional before transacting or implementing any strategies discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, nor any U.S. government agency. If applicable, we do not offer every plan available in your area, and contacting us at the phone numbers provided herein will direct you to a licensed insurance agent. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-Medicare to get information on all your options. All rights reserved.